Most traders think hedging means giving up on a trade. It doesn't. Hedging with micro contracts lets you protect a mini position while staying in the game, and I'm going to show you exactly how that works. If you appreciate me making this type of content, let me know by gently tapping that like button. Now, let's get into it. Hey traders, before I start, if you like our stuff, hit those subscribe and like buttons. Now, let's talk about futures trading. Trading mini contracts, like the E-mini S&P 500 ES, gives you serious market exposure and leverage. But with that comes real risk. A sharp move against your position can lead to painful drawdowns or margin pressure fast. What if you could protect those mini positions without fully exiting or adding oversized hedges? Enter micro contracts. Today, we uncover the truth about using micro E-minis and similar micros as precision tools to safeguard your mini contract positions, preserving flexibility while managing downside. Mini contracts, E-minis, are the workhorses for many traders. High liquidity, significant size. A 1-point move in ES is worth $50. Micro contracts are 1/10 the size. 1 MES point equals $5. This 10-to-1 ratio means you can fine-tune exposure exactly. 10 micros deliver the same delta and P&L impact as 1 E-mini, but you can use any number for partial adjustments. Lower margins make them ideal for surgical risk management. Here's how traders use micros to protect mini positions. Suppose you're long one or more E-minis, but want to reduce risk without closing the whole trade. Maybe you're still bullish long-term, but expect near-term volatility. You layer in opposing micro contracts. Long 2 ES, but nervous? Short 5 to 10 MES to hedge 25 to 50% of the exposure. If the market drops, losses on your minis are partially offset by gains on the short micros. This creates a dynamic shield. Because micros are granular, you can adjust in real time. Add more protection as volatility rises, or scale back to capture upside. It's perfect for delta tweaking, e.g., hedging options on minis or partial profit protection. The result? Reduced drawdowns on your core mini positions while keeping skin in the game. The truth isn't all upside. Micros excel at right-sizing protection for mini positions, better than using another full E-mini, which can be too blunt. You maintain liquidity, scale easily, and avoid overexposure. But realities bite. Transaction costs add up with frequent layering. Same underlying hedges have low basis risk, but imperfect correlation in cross hedges can slip. Leverage works both ways. Poor management leads to amplified losses. Overhedging turns a winner into a break-even or loser on rebounds. In fast markets or gaps, execution matters. In summary, hedging mini positions with micro contracts bridges big exposure and precise control. It's not a set-it-and-forget-it strategy. It's active, disciplined risk management that lets you protect capital without abandoning convictions. Test it in simulation first. Know the specs, use proper position sizing, and respect the leverage. Used wisely, micros help you stay in winning mini trades longer through turbulence. What mini positions are you protecting? Share below. Trade smart. Futures involve substantial risk of loss. If you like a template or two that we use, mention that as well in the comments. See you next time.